In this video we are going to talk about dividend stocks for 2022. So before starting, please like this video and subscribe to this channel for our future updates. The appeal of dividend equities should be growing at the moment. The Federal Reserve has indicated that it will begin withdrawing the market boost it gave during the pandemic in the near future. There was no immediate shock when the news broke in late September. After Labor Day, broader markets, including the S&P 500 index, moved down. However, with markets behind and volatility expected to rise, it makes sense to focus on the stock market's less hazardous segments. The dividend stocks for 2022 are listed below, and these stocks have the potential to remain appealing for at least that long. They'll rise with the market and pay out dividends that can be invested. Number 7. PepsiCo, NYSE, PEP. PepsiCo is a rather uninteresting investment, which is a good thing. It's important noting because we're talking about dividend stocks to hold forever. When you look at its price chart for more than 10 years, you'll realize how consistent it is. PEP stock was trading at $62 in October 2011, it is now trading at $163. Former CEO Indra Nooy deserves special mention. Nonetheless, even under new leadership, if you play the long game with it, or most other dividend stocks, you'll come out ahead. Since 1973, PepsiCo has paid a rising dividend on a consistent basis. As a result, investors were aware of this. In the past year, the quarterly dividend has equaled to an additional $4.20 return on a PEP stock share. Investors should expect Pepsi to continue on its current path of gradual, steady growth. According to consensus predictions, the company will earn $81.57 billion in revenue next year, up 4% from $78.39 billion in 2021. Number 6. Apple, NASDAQ, AAPL. I'm guessing that when it comes to dividend stocks, most investors don't even consider Apple. It's safe to suppose that many people are unaware that Apple stock pays a dividend. However, it does. And, despite its low forward yield of 0.59%, the dividend is growing. Apple has boosted its dividend at a rate of 10.4% each year for the past 5 years. On the one hand, the fact that Apple's dividend is 22 cents per share may not appear to be particularly appealing. Consider that Apple increased its dividend from 20.5 cents to 22 cents in May, or a 7.32% rise. That isn't likely to alter anytime soon. In early 2021, Apple pledged to regular dividend increases. When it did, it sparked speculation that it would try to join the illustrious dividend aristocrat club in the future. If that happens, it will happen in 2038. There's already a lot to admire about Apple based on how well it performed in 2021. However, if it diverts record profits to a growing dividend, it could seem even better in 10 years. Number 5. McDonald's, NYSE, MCD. When it was priced about $215 in 2021, McDonald's was on numerous dividend investment lists. Many projected that it would climb because vaccine rollouts were in full swing at the time, and people would soon be returning to work. People were inoculated to some extent, and MCD stock rose. Now that share prices have surged above $250, the story has become less appealing. Despite being at 3-year highs, MCD stock still has lots of room to run. Based on analysts' average stock prices of $267.60, this is correct. That means there's still a touch more than 7% upside potential. If you reinvest the dividend, which was just raised to $1.38 from $1.29, into MCD shares, your gains would improve even more. In the long run, it's difficult to see why McDonald's should suffer any significant decline. It is still a globally recognized brand. In 2021, global revenues are expected to increase by 40.5%. This is mostly due to the pandemic, although the company also saw a 6.9% gain in sales in 2021 compared to 2019. It shows no signs of slowing down, and it will continue to be a good dividend stock for a long time. Number 4. Johnson & Johnson, NYSE, J&J. Johnson & Johnson appears frequently on dividend stock lists. That's for a good reason. The company hasn't cut its dividends since 1982, and that payout, despite its low 2.64% yield, is as steady as they come. The company's payout ratio of 0.62 is fairly stable. 62 cents of Johnson & Johnson's net income is required for every $1 of net income. When you compare that to other oil businesses, it's easy to see which one will fall first. Even in 2021, J&J stock has largely behaved as a dividend aristocrat should. This year, there hasn't been much in the way of price fluctuation in its stock. When the pandemic began in March of 2020, it, like everyone else, began to falter. The fact that Johnson & Johnson's vaccine has been approved by the FDA as a booster dose is also a crucial trigger. Because the shot is sold for a nonprofit, the catalyst isn't a financial one. Instead, it's more in the form of long-term brand equity. Number 3. Lockheed Martin, NYSE, LMT. Lockheed Martin hasn't had a particularly successful year, according to most observers. However, investors might just as easily shun LMT stock altogether in favor of growth potential, but that would miss out on what the company is trying to do. The company has the potential for long-term growth as well as long-lasting competitive advantages. Each of the company's 4 business areas has experienced significant growth, with overall sales increasing by 5% year-on-year in the most recent quarter. That's a substantial amount for a company with the scope and scale of Lockheed Martin's. The upside potential of LMT stock is represented by the average target stock price of $378, which represents a modest increase from the current stock price of approximately $342. Furthermore, revenues are expected to climb by 26% in 2022, making it a promising year for the company. Although it is possible that revenues would reach as high as $29.7 billion, a consensus of $27.84 billion has evolved. Number 2. Exxon Mobil, NYSE, XOM. Chevron's story is similar to Exxon Mobil's. The company's finest days are behind it. Exxon Mobil is currently trading at $63.60, close to consensus predictions of $60. As a result, there's some upside in that forecast. Oil prices, on the other hand, are unlikely to fall anytime soon, even as they approach $80 per barrel. According to a recent Reuters piece, the supply shortage is expected to last for months. Exxon Mobil and other oil majors stand to prosper. As a result, buying XOM stock could be a good way to protect yourself from rising gas prices. Exxon Mobil is also looking good in the long run, according to broader indicators like the OPEC report mentioned earlier. According to Yahoo Finance, the corporation is expected to generate revenue of over $287.7 billion this year. In 2022, that figure is expected to climb to $296.75 billion. This should lead to very stable prices, which will be aided by the company's 5.55% dividend yield. It hasn't been cut since 2002 and has remained at 87 cents since May of this year. Number 1. Chevron, NYSE, CVX. Chevron may appear to be an odd choice to start off this list. The energy environment is undoubtedly shifting, with oil being the most vulnerable. Many experts believe that an oil demand peak has already occurred, and that the dinosaur, which is made up of dead dinosaurs, is dying. World oil demand will plateau in the late 2030s and may have begun to decline by then, OPEC said on Thursday, in a major shift for the producer group that reflects the long-term impact of the coronavirus crisis on the economy and consumer habits, according to the Oil-Producing Nations Alliance. Chevron makes sense as a comeback investment right now, as we near the end of the pandemic. It is currently trading at $114, with consensus expectations indicating a move to $129. As a result, there is a clear upside in the form of price growth. After that, investors will receive a dividend earning 4.89%. Since 1984, the corporation hasn't cut its dividend. Chevron recently increased it by a nickel in May. It was raised to $1.34 as a result of the increase, and it has remained there since. Despite an overarching green revolution, OPEC estimates and existing oil demand make it tough to ignore CVX stock. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.